Okay, did you? Okay. Well, I think hopefully, obviously, we have to get through the rest of the ratios today. So how are you doing as far as trying to organize yourself to start to learn these ratios? Do you have them like on flashcards or? Um, no, that's not an option. Right.
So which ones out of the like 21 are we going to have to know?
All of them.
All 21?
Well, I mean, I can ask any of them.
Perfect.
Right. 21 ratios?
Yes.
I would say 5 of them are tough and the other 16 are pretty straightforward. If we go over, for example, like let's just do a quick. 'Well, gosh, I don't know. I mean, I've never done that before. You've got open book on the tax test. Yeah, let me think about it. Oh, have them memorized? Oh, yeah, like these top 6 you use all the time.
Right.
That's going to be off the top of your head. That's what I'm saying. Of these, probably only 5 or 6 of them, I mean, are operating, like these you would know off the top of your head. You know how to look at your, what is this one? And why do you do that off the top of your head? Yeah, I mean, you're doing this every time you look at your balance sheet if you're like the controller or the cash manager. Same thing with both of these ratios. Right, so those are absolutely ones that you just know. I don't know what's wrong with the screen. Why is it cutting off? That part over there. Huh.
Well, maybe it's that little blue thing up in the corner.
Oh, there we go. Okay. So liquidity, you're going to clearly be watching all this AR turnover days to collection. So those first 8 you will use all the time, and you would know how to use those, just because that's how you're using those, probably daily, if not probably weekly. Yeah, they do. So how do you remember this? What does this look a whole lot like, or why did I put little stars on these? Yeah, yes. Exactly. The relationship on almost all these ratios that we've seen thus far, I think this is the 8th one, is saying for every dollar of something on my balance sheet, how much am I generating something on my P&L? In the one case, it was cost of goods sold. In the other case, it was, what was the other one up there? AR turnover, it was inventory. This is how much sales am I generating from my assets. This isn't so much something that you're keeping an eye on every day. What are you looking, I just burned myself this morning, ouch. What are you looking at this for? This isn't so much a daily management one like the first 7 or 8. Why do you use this one? So how often?
Generate your sales.
Probably
Yeah.
quarterly.
Yeah, it's probably like a monthly or a quarterly analysis. Because you're not buying long-term assets probably, on an ongoing basis. So you're looking. This probably would be like a quarterly analysis. So there'd be a packet of these that you'd probably do quarterly. So I would take that as one that you would use like on a quarterly basis. Okay, then we went into debt management. Oh, this is what we left off with?
Yeah.
Okay. Again, are you managing your long-term debt on a daily basis? Really only operational stuff, right? This is something you're going to look at when you're doing what? What kinds of decisions are you making when you're looking at this ratio? Yeah. Yeah, am I going to issue more long-term debt? Am I going to retire existing debt? What's EBIT again? I think that's what, didn't I ask you to calculate this for today? Yeah, and where do we find that on their P&L, our Marleya P&L?
Well, it should say net income, and then you should see 764,
Yeah, and in this example on Marleya, it says our other expense is interest expense. So what number am I picking up to plug into EBIT for 2012? No, I think it's operating income plus other income. It's 168.5.
Oh, okay, yeah.
Right?
Okay, yeah, exactly.
I'm going to have to recalibrate this. And they told us that. It would not always be the case, but those notes at the bottom left-hand side says, other expenses, interest expense. No, that's not like a rule that's always there. So 168.5, and then my interest expense is how much? So this one is quoted in times. What does that mean? My EBIT covers my interest expense 28 times. It's not a cycle in this case, actually. It would be the equivalent of saying, I earn $3,000 a month and my credit card interest is $260. So I cover my interest expense from my debt 12 times a month based on what I earn. It's not a return on investment. What am I trying to cover here, you guys? Does it say anything about paying back the debt? The principal of the debt? It's just like, if somebody's going to lend me money, they want to make pretty well assured that I can at least cover the interest payments and obviously also clip away at the principal. My earnings, before I pay my interest and my income taxes, can cover just my basic interest expense 28 times a month. Or a year, I'm sorry, this is an annual, pardon me. It's whatever you're looking at, obviously. These are annual financial statements. Okay, so that's the first in our debt management calculation. Second one, debt to equity. This is right in the name. What do you think you're going to divide by what? Right when you see that name, debt to equity. Yeah. My liabilities divided by what? That's it. I mean, it's right in the title, isn't it? So let's do our 2012 and then talk about what it means. Debt divided by equity, total liabilities divided by total equity. So is this going to be a ratio or a times or a the ratio? And usually, I hate to say always because there'll be an exception, but when you see something to something, that is a ratio, isn't it? Yeah, a ratio is something to something else, and that something's the base. Yeah. Oh, maybe I've got a typo in my notes. All right. You guys all got 37? Typo. God bless. It is 310 divided by, oh, that's what I did. I'm sorry. I picked up liabilities and stockholders' equity of 1.139 million. It should be 829.5, huh? 29.5, 0.37. So what does that show me? Of liabilities. What does that tell you about the firm? Or about the company, excuse me. This doesn't really talk about dividend paying capacity. It talks about, I'll just tell you because it's kind of tricky. It talks about capitalization. How is the company capitalized? And really, basically, they're saying for every buck of equity, you've got 37 cents in debt. So is it a highly leveraged company? Not really. I mean, again, everything's tempered with looking at what? You have to look at other like-kind industries. I don't know what Marlea does. Let's say they're a semiconductor manufacturing company and they operate in Bangalore, India. I would look at other like-kind semiconductor manufacturing companies and say, how are they capitalized?
Now what is that difference on where it's capitalized as part of the question?
This isn't really looking at that. This is, what if the number looked like this? What if it came out, now what would you tell me? We can't say way too much because we don't know enough about the company, but you would say this is a much more highly leveraged firm than this, right? It might be appropriate, like, you know, like anything that's poised for massive growth. I mean, this would describe Apple or Microsoft or any of those companies in the early days. The minute they came out of the garage, what did they have to get to scale up? Tons and tons and tons of debt because those founders weren't willing to give any of their equity away yet. At some point, you have to obviously give your equity away. Okay, so does that make sense? Is that one pretty self-explanatory? Debt to equity. Just pick the numbers straight off the balance sheet, and it tells. It gives you a snapshot of how the firm is capitalized. Also, probably like the times interest earned one. Probably done on a quarterly basis because you're not issuing bonds or retiring bonds or issuing stock on a regular basis, right? Okay, and then what page are we on in the book? Sorry, I just want to make sure that I'm using the exact same titles they do. I'm sorry. Yeah. Yeah, same. Honestly, I don't even know that I need, I mean, this is another one to look at and how you manage your debt. And I can tell you, you can bring in these three formulas for the debt management, just because these aren't ones you need to know off the top of your head. You're only going to do these quarterly. You would know them, though, honestly, because you would be doing this every quarter. So this is another debt management technique. So you're going to use these three formulas together. This being one of them, the times interest earned, shows you your ability to pay back or at least cover your interest payments. The second one saying, hey, how highly leveraged am I? In other words, if you look at how I'm capitalized, what is my percentage of debt compared to my percentage of equity? And this last one, an equity multiplier, really shows the higher this number is, the more leveraged you are. So let's see if we can get this multiplier, and then we'll talk about what it is. Okay. The heck does this mean? Take total assets, divide by 2, that's your numerator. Total equity divided by 2 is your denominator. Nope, 1185000. Right? What does this show? The equity multiplier for every. No, you have all. Whenever I say every, for every $1 of equity. Yep. So what? So what? Am I funding my assets with debt or equity? I'm not very highly leveraged again, what we just saw in the last one. Mostly my assets are coming from what? Investment in equity. In other words, issuing stock or retained earnings, right? So am I issuing a lot of debt to buy my new assets? No. Again, it's hard to do this in isolation. You really would have, and you've got access to it in databases, you would have a composite of what other companies' equity multipliers and EBITs and times interest earned and all those were, so you could make a reasonable comparison. You can bring these three formulas in, just because the debt management. And divide by 2. So my numerator was 1185000. My denominator was 808500. Okay, moving on to profitability. These you would just know because you would use these all the time. And if you have multiple product lines, you would know, per product, you would know these figures off the top of your head. Because this is how, in the first step, we were managing liquidity, right, which is cash flow. You've got to also be managing profitability all the time. So let's figure out our gross profit percentage. And you guys should know that formula. What is that? If I want to figure out what percentage my gross profit is. Yes, and I don't think in the book they just say sales, but excuse me. Is that going to be net sales or sales? Net sales is the denominator for almost everything. But in this case, what am I really trying to get after here? Not fixed, that's contribution margin, close. It's not variable and fixed here. We're back to our traditional financial statements. No, so picture the P&L. Huh? Okay, everything except for what? Gross profit is what minus what? You can look at your P&L. Sales minus costs. So that you were really close, Jeff. So basically it's saying, what percentage do you have left of every dollar of sales to cover what? All of your operating expenses except for costs. This is a number you're going to manage actively all the time, right? So let's see what our percentage is for 2012. Sales, because in this case it is important to me to analyze, what percentage is coming back in the form of returns. What year are we doing? 2012? 455. And then do 2011 and then make me an assessment of what you think's going on. How's it trending? Is that concerning? No big deal, just a percentage point or what? It really is something you need to very tightly scope, because losing that percentage of sales is indicative that is it indicative of lost sales? What's it indicative of? I guess that's what I want to ask. And it doesn't show that you have too much inventory. It shows that what? You paid more for your inventory, or what? You either paid more for your inventory than in the prior. Not so much you sold less product, but you sold it for less per unit, right? Okay, did everybody kind of grasp that? So there's only two numbers in this calculation, gross profit and sales. And gross profit is sales minus COGS. So the only two things that can impact us is the price you paid for your inventory, i.e. COGS, or the price you sold your product for, i.e. sales. Now, let's see if you can do this. Figure out the horizontal analysis from 2011 to 2012 on this. And don't forget now, you've got it, when you do horizontal analysis, do you go from what percentage did my gross margin change? No, you guys calculate it. What percentage did my gross margin change? I mean, I can see absolutely it changed like a percentage point, but horizontal analysis, you always find the difference between the 2 years and divide it by what? The base year. Is it 19.7? That sounds about right. Yeah, is that what you guys got? Let's see. 0.308, 30.8% minus 0.297 divided by 0.297, it's 3.7. My gross profit went down 3.7%. That's concerning from one year to the next. Okay, let's look at some other profitability indices. The next one is return on total assets. Return on total assets. Oh, okay, yeah, let's just, so net profit, yeah, gross profit, net profit, thanks. It's going to look exactly like this, but it's net income, right? I just want to kind of get onto the trickier one, sorry, but that net income percentage is, yeah, net income divided by sales. Also something in business that you would, I mean, you would be able to talk about these over lunch. You know what these percentages are. You're actively managing these, both of these. I'd say the next one could also be called a quarterly analysis, so you can put that on the list of what you can bring. You're not going to know this next one on a daily basis because it's based on your assets, and again, you're not changing your asset base on a regular basis. ROA, return on assets. So this is basically saying, there's kind of one little tricky thing here. It would be totally easy if it was just net income divided by assets. But it's not. There's one little additive in here. So return on assets, whenever you see return, that means your numerator's what? Not so much an average, it's going to be income. That's what a return is, right? Return on assets, return on equity, return on debt, that always basically means that your numerator is net income. But what we have to add back here is interest expense. In other words, they want to pull a number, not EBIT, which is interest expense and taxes. This is just pulling out the cost of financing the assets. So you have to add back, and I'm going to bracket this. Again, it's not that easy. You have to add back your interest expense, but it's going to be post-tax or pre-tax, and you want everything post-tax. So 1 minus your tax rate. So your numerator, you're going to, and we'll do this one together, you're going to go pull your interest expense and multiply it by 1 minus your tax rate so that you've got them both on post-tax levels. You can't take a pre-tax number and a post-tax number and add them together. So let's just work through this one together. What's my net income? I'm sorry? Net income. Okay. And what's my interest expense? Yeah, and they tell us that. And I'm going to multiply that by 1 minus my tax rate, so that equals what? 0.7, because they tell me my tax rate is 30%, right? And then I'm going to divide that by my average assets. No, they're a bunch more than that. That's at 1,185,000, right?
Yeah, 1,185,000.
Return is always quoted as what? Times, percentages, dollars. I think it's quoted usually or always as a percentage. For every dollar of assets, I'm generating 8 cents in net income with an add back of my interest expense. You can put this one on a list as something you can bring in. So we've got 4 ratios so far that you can bring in that you're not doing that you wouldn't need to know on a daily basis. So that's ROA. The next one's ROE, return on equity. If that one was telling us how well we use our assets to generate income, this tells us how well we're using our equity to generate income. And this is simply net income divided by average equity. So I'll give you a second to do this. I'm sorry. So do they use common equity or just equity? Yeah. Yeah, so, all right, let's do this, and then I've got to show you kind of an alternative to this that's actually more common. So we know what our net income is, right? 91. And what's our average stockholders' equity? I think it's 808,500. It is a percent. Is it 10.1 or 10.0? 91,000 divided by 8,085. Oh, 11.3, yeah. So tell me if you're sitting in a meeting and your board chair asks the difference between ROA and ROE. ROA, return on assets, and ROE, which is return on equity. That's exactly it. How well am I doing using my assets to generate income versus how well am I doing using my equity to generate income. Why are equity and assets not the same thing again? Picture the big categories on the balance sheet. Right, so what's the difference on the balance sheet between your assets and your equity? That week one accounting one. Retained earnings is in here. Assets equals, right, the difference between them is your liabilities. So this is all part of that kind of looking at your debt management and how you're capitalized and what you're utilizing to generate income within your business. Again, the question is, do you want these numbers trending up or down? Do you want them going up or down? Up. Up. You want every dollar of either equity or assets to be doing what? Generating income, right? So you want these numbers to trend upwards. You would also look at these in collusion with the debt management percentages and other like-kind companies. Sure. Oh, absolutely. Absolutely. And then the last set, and boy, aside from book value, you're going to know all these on a daily basis too, particularly as a manager, because your compensation, your bonus is probably based on it. Market performance, and I think we've looked at these before. What is earnings per share? Earnings per share. What does that really mean? Where are you going to get your earnings number from? Huh? Yeah, it's your income number, isn't it? There's going to be more here, but let's just kind of work through this in our minds. So earnings per share, so earnings is my net income. What's the share? Number of shares of what? What kind of stock? It's common stock. And somewhere in your notes you just need to make, it's not in the title, this is a common stock calculation. Likewise, since it is a common stock calculation, when you have net income as a business, who gets the share of the dividends first? And so what they want to know is, this is a common stock calc, so the first people to get a shot at this are your preferred shareholders, so you've got to pull preferred dividends out of here. All right, and this is quoted as dollars per share. All right, let's work through this one together. So numerator, what's my net income? Right, 91,000. Where are you going to get the preferred dividends? Yep, so let's just go straight to our balance sheet. And we got 150,000, right, of outstanding. What percentage of that am I paying over in dividends? 6% or $9,000, right? Everybody see where I got this number? Preferred dividends, 150,000 times 0.06. Numerator, average shares of common stock outstanding. Where are you going to go? You got to go to the balance sheet. Does it overtly tell you number of shares? How do you figure it out? And it hasn't changed. So the average is what it is. I went to the balance sheet, and I saw there was 500,000 in common stock, and that there's $10 par. So that means there were 50,000 shares, right? So my earnings per share is what? This is actually something you would follow on a daily basis, your earnings per share. These numbers don't change because how often do you really issue or retract stock, right? Not so often. This number, earnings per share, well, no, that's not true. You wouldn't do that on a daily basis because you don't know your income on a daily basis. You would probably do this as a monthly analysis. Is it actually the cash? Really good question. Look at the numerator for a sec. Is that the cash that goes out? It's not value. Value is the market. What is that, you guys? Numerator, net income minus preferred dividends. Is that the cash that's paid out? It's what's available to declare as dividends. You could distribute $1.64 a share. Does that mean you are? What did they actually declare for dividends for the common stockholders? So the first number you need to know is what capacity do I have? The second thing is what am I actually going to do? Do you see that? Yes. Yeah, I've never really heard that term, but yeah, that would roughly describe it. Sorry, come back to that, I don't know. Yeah. That's one. Check the other is, do we have any cash? I might have tons of net income and no cash. Or I might be saving my cash to do what? Like buy a building, expand, buy one of my suppliers, right? Pay off bonds.
So that's the cash that's sitting.
No, it's absolutely not cash because you're starting with this number, which is an accrual number. That is one of the toughest things and one of the first things you guys learn in accounting, and I still have people going out the door that are a little confused between income and cash. If I have a little bakery business downtown, it's probably the same flipping thing. If I'm running a big company, it is most assuredly not the same thing. Okay, so another ratio that goes hand in hand with this one that's very important is PE ratio. Good golly, we're running out of time. two ratios, you guys, the one you just ran, and this one are used together. Okay, these are like sister stats. Price to earnings ratio, and this is PE ratio stands for price to earnings. You just calculated the EPS, so that's your denominator. Market price when? Where? For what? What are we even talking about? On 12/31. Where am I going to get that? Yeah, they give it to us, but in reality, where are you going to get that? If you're, running General Electric, where do you get this number?
Check it out every day.
It's running across the bottom of your computer screen in multi, increments of seconds. Good news, blip up. Bad news, take.
So that's 2050.
That's how much everybody's paying for one share of common stock. And this is no. She is sick. Sick of management. It's really unfortunate because this is really the crux of what's interesting in accounting, is using the numbers to manage the business. I wish you loved it. I love it.
I don't like it. I just well, but now, the EPS would be 1.64.
This, I'm going to talk about this in a second, is a hugely critical number. It's quoted in times. What does this one end up being? 12.5. Does anybody see the incredible relevance of this? What's the price of your stock doing compared to the earnings per share? What do you think happens to this number, to the stock market as a whole before the market crashes? You can go through history, all the way back to 1929, 1948, 71, 91, the dot-com bust in 2001, the economic recession in 2008. What happens to this number right before a crash? Well, first it's overinflated. It's super high. It's at like 30. So the price of the stock has been skyrocketing, but it's not based on any operational performance. And when you have a stock market comprised of things like Facebook and Google and Yahoo and Amazon, Amazon's not a good example, but all these companies that really weren't generating any income, but had these crazy prices. And I will tell you one thing right now, average over time, PE ratio for the stock market on the whole over time is around 15. And right now, it's up above 20. What does that mean? We're getting ready for they call it a correction. The media calls it a crash. We're getting ready to see another one of these where you pick up your portfolio and like, holy crap, I'm 30% poorer today than I was yesterday. It's all a bubble. It's built on hype. There's nothing being made and sold. Is this your econ teacher?
No, that's just.
No, go ahead and share that. I'd love to hear that, and then we'll close.
It's like 40 million, if not more. I got markers.
What does that do?
They're just keeping markers.
How are they doing that? So they're putting money in to do what?
They're buying.
Yeah, buying stuff. They're just buying.
Stimulate.
I don't know.
They're not buying stock. They're keeping interest rates so artificially low that money is almost free right now. Money's not free. So our economy is going. I'm sorry, say that again. Right, and is that really sustainable? No. So honestly, we're poised for kind of another.
If that